Well, joining us now is Suzanne Haddan, Managing Director of BFG. Great to see you this morning. A really interesting place at the moment, aren't we? All the speculation points to the fact that the Reserve Bank wants to raise interest rates, but it's not going to do that for some time. It made that clear this week.
Well, it's been interesting because the rates have been at 1.5 for 13 months now. So we can all become a little complacent, but I think we're not even near neutral territory, which rates would be 3.5%. So I think that sends a strong message to borrowers, to investors, to look at their affairs.
So that's a warning essentially saying these are unprecedented times really, and that the rates have remained so low for a considerable amount of time, but we should factor in that they will actually will rise at some point, of course, and that people need to be prepared.
I think that's a really strong message. I think at this point you need to be looking at your home loan, for example, and assuming rates to be may normalise at around 7% and start building a buffer in your loan now to protect you. All evidence suggests that there are many people out there who could suffer mortgage stress if we have a normalised interest rate rise of 2%. That could be another $1,000 a month of repayments for the average loan in Sydney.
Is that what you tell clients to, when you talk about a buffer, that you say, let's factor in another 2% rise? Is that what you're saying?
We're doing our loans at 7.25 at the moment. Even though they might be paying 4%, let's do the repayments at 7.25. We realise it's no fun. As soon as you talk about budgeting, you can almost hear the groan from the viewers, can't you? But it is really essential that you sit down and look at your finances and see where you can squeeze some money in from your budget to get your loan in hand.
Are you surprised by how many people don't take that advice and don't actually put aside that money for a buffer?
I'm not surprised because we all like to enjoy ourselves and help the economy by getting a new pair of shoes or, what do they say, the smashed avocado and a latte. But the reality is that we have been borrowing at unprecedented levels because of the property prices, and that's going to have repercussions. I think we'll look back and say, we could see all the signals. What did we do about it?
When do you think the move up will come?
Well, economists this time got it fairly right. I think most of them assumed it was going to stay the same, but most times it's almost 50-50. I think we need to prepare now. It might be a year away, might be longer, but get your house in order right now.
How would you assess the environment more broadly as far as what the RBA is looking at, particularly with inflation? And when I talk about inflation, one factor that may influence that heavily are power prices. Of course, they're on the way up quite rapidly at the moment. Is that likely to affect the household budget?
It absolutely affects the household budget. I noticed in mine, and not that we're under any stress, but you certainly noticed a jump in your power prices, and that is going to put pressure on the ability to build the buffer for the home loan. So something else has got to give.
At the same time, we've seen the Aussie dollar rising. Not terribly good news for exporters, of course. This is because the US dollar essentially is falling.
Correct. It's not so much us rising as them falling. And while you might get excited for your next overseas trip, it has adverse implications for the Australian economy. The Reserve Bank wants the Aussie dollar lower.
Let's talk overseas. Are markets in the US breathing a sigh of relief after that somewhat surprising deal that Donald Trump did with the Democrats in relation to the debt ceiling?
I think the Texas aid probably helped pushing everybody to a resolution, somewhat temporary though, because what are we looking at? 15th of December, just before Christmas, we'll be facing what are they going to do now? The classic case of spending more than you earn. There's such buoyancy, isn't there? You look at the US market at 22,000 or just under at the moment and you think, where is that coming from? But they have had strong employment growth. There was general excitement about possible infrastructure spending. Markets are driven by sentiment.
In reality, though, the President is probably going to have to keep tapping Congress as far as that debt ceiling is concerned, because we look at these crises, the natural disasters that America is facing at the moment. We talk, obviously, with the latest hurricane. Emergency funds are going to be required.
Well, you look at it's somewhere between 9 and 15 billion now that they're going to have with Irma. There's going to be extra costs. That is going to place increasing strain on the US deficit position, absolutely.
Now, let's go over to Europe. And the European Central Bank has raised its growth forecast at the fastest rate since before the financial crisis began to bite way back in 2007.
Who would have thought we'd get so excited to have it over 2.2% forecast? But that's the best for 10 years. But their inflation is still quite low. I think the forecast 1.2, maybe moving up to 1.5. But there is some enthusiasm that they come out of the depths of the GFC and are starting to show that growth. That has implications for us and how we invest and allocate our resources in Australia for our investment portfolios. But it's great to have some positive news for people, I think.
But Suzanne, is it fair to say that Europe has recovered? Because you look at what happened post-GFC and the debt crisis, it never really went away, did it? What's happened to the debt?
Well, the debt's still there. It's sort of shifting around, isn't it, to a certain extent. So their problems are far from over, but it is great to have some optimistic outcomes.
Well, they do still have to decide on stimulus measures, don't they?
Yes,
right.
Which they've been very enthusiastic on those.
All right, Suzanne, thanks so much for the latest on business and finance.
My pleasure.